in this setting.
Word one. Good afternoon. I will call to order the City of Salem and Salem URA Finance Committee meeting for August 17th. I am Deanna Glenn, the chair.
Paul Tigan, Ward 1. Shane Matthews, Ward 3.
Vanessa Nordyke, Ward 7.
And staff.
Oh, Krishna Namburi, City Manager, sorry.
And Sherman Thomas, Management Analyst.
Jeremy Morgan, Financial Reporting Manager. Danny Atchison, City Attorney.
Kristen Rutherford, Community Planning and Development Director.
Josh Eggleston, Chief Financial Officer.
Ryan Catchworth, PFM Asset Management.
Welcome.
Thank you.
You can sit up here at the table. if you
Okay,
like.
I'll join you at the table.
Nice.
We do have
How many are
a
coming?
few people online. Dana, do you want to introduce yourself?
Hello, Dana Decline, Assistant Director of Urban Development.
Thank you. Pete, Chief.
Good afternoon, Dave Grabo, Fire Chief.
Thank you. Tammy.
Hi, everyone. Tammy Laura Baker Tilly. Sorry, I forgot the other 8 letters after my last name. Tammy Laura Schweitzer, Baker Tilly.
Welcome, everyone. Did everyone have an opportunity to review the minutes from our last meeting?
I did, and I'd make a motion to approve the meeting minutes from our last meeting.
Second.
All in favor?
Aye.
Motion passes. We have no one here for public comment, no action items, so we have management update information items. Take it away.
Thank you, Counselor. And I'm going to introduce Ryan with PFM. He's going to go over the quarterly investment update. We're working on kind of a timing strategy, having come with the Finance Committee a couple times a year. So this is the first time. It's fairly new to our account, but not new to investments. Take it away.
Thank you so much. Appreciate it. Thank you for the introduction. I will test technology right now. I am signed into the meeting. We did do a trial run just a moment ago, but let's see if it carries through and I can share my screen. Okay. I hit share. I'm going to hit share again. Okay. Very good. I'll go ahead and dive into it. So again, my name is Brian Catcher. I'm with PFM Asset Management. PFM has had the privilege of managing your core fixed income portfolio for several years now. I started with US Bank, which is the parent company of PFM back in 2009. Spent several years with the bank, left and was in the public sector for over a decade and returned last year and joined the PFM Asset Management investment side of the house. I'm very happy to be with you today. I'm office in Billings, Montana, but make it out to Oregon about every month and try to meet up with the team as often as possible. So it is our practice. I know you've met probably with Lauren or Ruby from my predecessors before, but just a quick overview. We, in addition to managing your portfolio, we try to communicate frequently and keep you well informed of why we're doing what we're doing, what are we seeing in the markets, what are we seeing in the economy. And so it's very much a team effort as opposed to our traders behind closed doors doing their thing without your input and without me communicating back to you what they're seeing and what they're doing. So along those lines, at least every quarter, if not more, we try to present to you, 1, what are our economists seeing in the markets, and then 2, how has your portfolio responded to that? That being said, I'll dive into the market update. I'll spend just a moment on this slide here. We try to start out with a high-level summary. What are the most significant points in the market? It all boils down to the Federal Reserve. Are they going to raise rates? Are they going to lower rates? How is the market reacting to that? The main drivers of the Federal Reserve's decision to raise rates or lower rates is the health of the overall economy, specifically inflation and labor. If inflation is high, the Federal Reserve might feel compelled to raise rates to combat an overheating economy. And if unemployment comes up, the Federal Reserve may be inclined to lower rates to help stimulate the economy. So as I go through these slides and these data points, we should be asking ourselves these questions. Does this data encourage the Federal Reserve to raise rates or lower rates? And sometimes data gives a contradicting message. So we'll take a look at that. In summary, and in short, the GDP is the main indicator of the strength of the economy, and GDP and other macroeconomic indicators are very strong right now, despite we, the consumers, face a lot of headwinds in terms of inflation and eroding real income. So how is the economy so strong despite we, the consumers, feeling a lot of the pain of inflation, that kind of thing? A lot of it is, no surprise, tech-driven and AI-driven. Booming tech, booming AI is overshadowing one of the pains that we're feeling at the consumer level. We'll talk about that more in just a little bit. The Federal Reserve, for the last 5 meetings, has chosen to hold rates steady at the 3.5 to 3 3/4 rate. So again, we talked about conflicting data. It has been very conflicting over the past several meetings, and they have opted to remain patient and hold rates steady. There's a lot of market sentiment that they will raise rates, which is a dramatic change from where we were before the conflict in Iran. Our house view on that is they are more likely to hold steady or lower rates before they raise rates. We'll talk more about that in just a little bit. We, as your investment advisor, we see a lot of value in the short end of the curve. So your portfolio is allowed to invest up to about 5 years. We see a lot of value at about a 2-year range, and I'll show you what that looks like on the yield curve in just a moment. I will give you, I plan on about a 10-minute presentation. I don't want to take up a lot of your time. That being said, feel free to interrupt me at any time. I can linger on any one of these slides. And of course, there'll be time at the end for questions. So I talked about the main inputs that the Federal Reserve uses, being labor and inflation. This slide here talks about inflation. If I use my mouse here, yeah, there we go, that's showing up. So the yellow shows core inflation. The blue bars show overall headline CPI inflation. The difference between the two is that core whittles out the price of energy and the price of food. Those commodities tend to be very volatile. So there's value in analyzing each of them independently. So the story that this tells us is inflation is going up, but it is overweighted by the highly volatile energy and food prices. And of course, that's going to be directly related to the demand when it is shipping to the Strait of Hormuz, which is driving up the oil, which drives everything else up. What does that mean for our interest rates and the Federal Reserve's decision? There's a difference between a cost push inflation, which is what we're seeing right now, and the demand pull inflation, which is what we saw during COVID. Cost push inflation tends to be more temporary and intertwined directly with the specific event that is pushing prices up. The good news about that is it tends to be shorter in duration, as it is limited to the whatever, in this case, the conflict in Iran, or whatever the input is that's driving that cost. That's reflected in the line chart on the right here. The blue line shows market expectations of short-term inflation. The yellow line shows market expectations of long-term inflations. The gap between the two shows that there is the expectation that this inflation that we're seeing right now is not long-lasting. It is directly related to the conflict in Iran. There is market optimism that the conflict will end and that inflation will normalize. The gap between the two also suggests that the Federal Reserve is not going to be too eager to raise rates. In anticipation of a shorter duration inflation, they don't want to make any moves on something that's expected to not be lasting duration. So in summary, the expectation of the takeaway from this is the Federal Reserve has caused to be patient and not jump on raising rates right away. The second half of the macroeconomic picture is going to be labor. The market priced in expectation that the Federal Reserve would lower rates over the last couple of years based on this rising unemployment. But you can see here that in the last several months that it has flattened out. 4.5% unemployment is kind of a tipping point. where anything above that is viewed as unhealthy, problematic, and assigned to the Federal Reserve to lower rates. We have stayed below that critical threshold at 4.2. And then last read came in at 4.1. And so it has stable off. Again, another indicator that the Federal Reserve should not be too hasty to make any moves with interest rates. And then the chart on the right here, this is what I was talking about before with eroding personal income. So the light blue line shows real personal income. Real just means adjusted for inflation. So anything below the 0% line here shows that inflation is increasing faster than wages. And we did dip into that territory earlier this year. Meanwhile, spending has remained steady. Any gap here where income is going to be below spending is a warning sign. It's a red flag. It's not sustainable. And again, this would be interpreted by the Federal Reserve as a reason to not raise rates. Even if inflation is coming up, this would be an argument to say, hey, let's not raise rates too quickly. The consumer is suffering in this economy. I won't spend too much time on this, but I mentioned at the beginning that GDP is strong despite some of the economic headwinds that we're facing as consumers. This shows why. The dotted line and the number at the top shows year-over-year GDP growth, and the light blue line shows the portion of that that is made up by tech investments, AI specifically. So GDP numbers have been quite volatile, but in a healthy territory, with the exception of Q1 2025. They're above, for the most part, the 2% mark, which is a healthy range. Higher isn't always better. You don't want it too high, you don't want it too low. Anything around 2% is healthy. And what this shows is an overall healthy GDP, but ever since the beginning of 2025, disproportionately heavily invested toward tech, AI, and all the infrastructure that surrounds that. I do want to call out one distinction between the heavy tech investment that we see today versus, if you remember the dot-com bubble of 2001, there is a difference between what we're seeing in tech today versus back then. Back then, it was very, very, very speculative. You could throw a URL or a .com at the end of your business, and all of a sudden it jumps up because if it's on the internet, then it's going to be big. It was very speculative back then. That caused a bubble, which caused a lot of economic pain. This is not viewed as a bubble. It is very, very, very much demand driven, and supply for now is not keeping up with demand. So we're not in bubble territory right now, although tech investment is disproportionately high. So what does that mean for the Federal Reserve? What does that mean for interest rates? This is the dot plot. Each member of the Federal Open Market Committee has the option, not the obligation, Kevin Warsh opted out, to cast not a vote, but a projection of where they think rates should be today, where they should be at the end of the year, next year, out to 3 years. And what we've seen lately is a lot of disparity. And in the most recent one, I'm going to highlight with my mouse right here. This represents where we are today, 3.5% to 3.75%. They don't determine a rate, they determine a range. So where we are today is represented as the space between these two dotted lines. And this year, more than we've seen in recent history, we see 1, 2, 3, 8, 9 actually not voting, but projecting a rate hike in the near term. So you can see that there are some that are reacting to the headline inflation. They are indicating an intention to raise rates, but you'll see the long-term trajectory has been and still is a bias toward lowering rates down to about that 3% mark into the future. How is that reflected in the yield curve? A quick overview of what this is. On the x-axis here is time, short-term 3-month, all the way out to 30 years. On the y-axis here, we have the rates. And so this image, this chart, is a microcosm of the Federal Reserve and the market and everyone's expectations and interpretations of where we're going and what they expect to see The solid blue line here is where we were at the end of Q2. The dotted line shows where we were at the end of the quarter before that. And this shaded light blue area shows the 1 year range. And you can see what a journey we've been on. 1 year, of course, captures pre-conflict in Iran, when there was expectation that the Federal Reserve would lower rates. You can see that in the dip, the 2 year range there. Whenever it's inverted like that, it means that the market expects the Federal Reserve to lower rates. Rates were right up in this territory. The market was saying they're going to come down. And so there was an inversion of the 2 year mark. But when the conflict in Iran started, you saw that go all the way from the low end of the range, all the way to the top end of the range, which is where we are today. Conflict in Iran caused inflation. Inflation caused speculation that the Federal Reserve would not cut rates, but might even raise rates. So that's why we saw that 2 year range mark come up. The 2 year mark is significant. It's very sensitive to market expectations of Federal Reserve decisions. Whereas when you get beyond that, it's less about short-term Fed rate decisions and more about macroeconomic indicators in terms of strength of the economy, inflation, so on and so forth. So I'm going to pause here really quick just to say, we can see the whole picture here, but your portfolio lives in this space right here, 5 years and shorter. I started by saying that our analysts and economists see a lot of opportunity right at the 2 year mark. And I'll say why that is very briefly. If you're starting at 2 and only going out to 5, you can see there's not a lot of opportunity. Whenever you go further out the yield curve, you're assuming additional risk. If you assume additional risk, you should be compensated for taking on the relative risk. As you see here, it is flat between 2 years and 5 years. So why go further out and assume that additional risk if you're not being compensated for it? That's why our analysts see a lot of value in the 2 year mark right here. We're investing heavily in that range. And if rates do go up, that's okay. That's what the market priced in. We're ready for that. And if the rates hold steady or go down, well, we've captured a lot of opportunity by locking in at higher yields when rates, in fact, go back down. So that'll be positive for your calculations. The next part of the presentation dives into your portfolio. Before I do that, any questions or any commentary? Anything you'd like me to dig deeper on and return a report for you? Okay, I'll keep going.
I certainly have one question. I mean, I think part of it is sort of a team question between our finance group and your team's portfolio management is how is it matching up when it comes to what we've budgeted? You know, we budget on some expectation of growth out of our portfolio. And so the rubber really hits the road in terms of what kind of resources get returned to the city. You know, none of us are investment experts. So the question then becomes like, well, are we getting what we expected in order to do the work on behalf of the city? You know, last year, you know, in the first quarter of this year.
Yeah, I think we budget pretty conservatively for investment earnings, not knowing exactly what's going to happen. So I think usually what we like to see is a greater return than we actually budget for. So we're not counting on it for operations,
right,
and things like that. So we try to budget conservatively and hope for those earnings to come in higher, and that gets captured when we reforecast, like in January when we present the 5 year forecast. If earnings are coming in higher than we budgeted, we'll reflect that and it'll roll into fund balance. So there's some level of pretty conservative practice there, but you capture it when you're reforecasting.
And that's where it ends up, is in fund balance. So if we had $36 million, then now we have $38 million, whatever the case may be.
Or 36.3 or something.
Right, yeah. Okay.
Can I ask just historically, because your projections, at least on the 2 year, are kind of counter to what I think most of, like we were saying, most people expect to see with larger gain in rates over that time. So what historically, like how accurate have your projections been in competition with the just kind of general market?
Good question. Our performance is publicly available. It's the GIPS reporting. You can find it on our website. You can find it or an independent Google search. PFM Asset Management has consistently outperformed relative to benchmark and relative to competition. So we have a very, very strong track record. The slide I have right here is an indication of that as well. And maybe that will address your question to some extent as well, about how has performance been relative to expectations. So we pride ourselves in being very transparent and also being very accountable. So each quarter we don't just report this is your performance. Performance is only relative, or is only meaningful relative to a benchmark. If I say, hey, we did 3% this year, well, what did the market do? 3% might be a great year, it might be a bad year. Okay, a negative return could be a good year or a bad year, because what really matters is our performance relative to the benchmark. And you, as the city, determine what the benchmark should be. A shorter benchmark would be a 0 to 3 year, or a 1 to 3 year. You guys are at a 1 to 5, which is very standard for the municipal institutions that we serve in the Pacific Northwest. And the gray bar here shows what that benchmark is on, and that's not our calculation, that's independently reported. It's in the footnote here, ICE Bank America 1 to 5 year US Treasury Index. Okay, and then the solid blue shows our performance relative to that benchmark, all the way out to 10 years. So
Is that an index others regularly use, this US Treasury Index?
absolutely.
Okay.
Yeah, that it would be considered an industry standard.
Okay.
So whether you're with us or any of our peers, they would use a benchmark issued by the same institution.
Mhm.
So
I had a question. I mean, you talked about how risk increases over time. I thought US Treasuries, how is there, I was under the impression Treasuries didn't offer a lot of risk.
they're risk-free. Very good point. Very good question. So there are different types of risk.
Mhm.
There's inflation risk, there's reinvestment risk. What Treasuries protect you from is credit risk.
Mhm.
So it is considered risk-free in terms of the US government is not going to default
Right.
on your loan.
Yeah.
The risk that I'm speaking to when I say you take on more risk when you go further out the yield curve is the uncertainty around what will interest rates be
Okay.
into the future. So we could lock in today, going back to the curve. Great question, by the way. We could choose to lock in today at 5% for 30 years.
Mhm.
Okay, risk-free means US government they're not going to default. They're going to be good for those payments over the next 30 years.
Mhm.
However, what could happen is inflation can be a lot higher than we expect.
Mhm.
And in the next 1, 2, 5, 10 years, a 30-year bond could be good for 6, 7, 8, 10.
Okay.
Who knows how high? And at that point, we're still getting paid,
Yeah.
but.
You've left an opportunity on the table.
Correct.
Yeah.
All right, thank you.
Good
That
question.
clarifies that.
Ryan, I have a question as to how this applies to the development world that would be helpful to me and probably to some of the counselors. Because I'm getting feedback from some of our projects that they are struggling to find investors, that the returns are not high enough, based on the risk of interest rates, of tariffs and labor costs and other things. And is that consistent with what you're seeing?
I'm not sure if I caught that. So
Right,
the
so-
feedback you're getting
It's
is,
from developers
Okay.
who are trying to put together their performance on projects.
give me an
Saying that
example.
then they keep pushing it out, real estate development,
Okay.
so multifamily, single family development. Right?
Okay,
Where they're saying that they are struggling to secure investors in their projects because of these variables are so rapidly changing.
Okay.
And that with that risk profile, investors are preparing to stay on the sidelines. And I just want to see if that's consistent with what you're seeing.
Good. Okay, very good question. So I would say, first of all, I don't necessarily have an opinion on investors into private real estate projects and that kind of thing, just because that's so far outside the scope of anything that you would invest in. But I'm not surprised to hear that either, because everything that we hear about the economy right now is very turbulent, right? With geopolitics and uncertainty around AI and inflation. And so what you see is people, not that they don't invest, but they go heavy in safer assets, such as what you invest in, treasuries, high grade corporate bonds. And
You see a flight to quality often in these kind of times. We're not investing as much in speculative real estate deals, but more bonds and things, we're allowed to invest in only, so.
I mean, another indicator of that, and I'll get to that in just a little bit, is corporate spreads are very tight right now. And so what that means is the yield that you can get on a high grade corporate bond is a little bit higher, but not much higher than what you get on a treasury bond. What that means is people are buying up high grade, safe corporate bonds, which is pushing prices up and yields down. And that's very much what we're seeing right now. Just like Josh said it perfectly, flight to safety.
Yeah, that gives some good context for projects that are slowing down or might not be moving forward.
It's interesting because I would think with lower interest rates, they could borrow more cheaply, but that's not the same thing.
I think a lot of developers anticipated that interest rates would be going even lower than where they are, and they've stayed stable.
Mhm. Okay.
Good question. Do we have a couple minutes to look at the portfolio?
Yeah, that's good.
Okay. So here we're transitioning from what's going on in the macroeconomic environment to what is going on in your portfolio. So this would be the long-term core portfolio. 327.4 billion is the overall market value. You have other community improvement bond proceeds portfolios that we manage. Details of that are included in the deck that was distributed. Just for brevity, I'm going to focus on the long-term portfolio right here. Duration, that is speaks to sensitivity to movements in interest rates. It is related to, not one for one, but affected by the weighted average maturity of the investments that you hold. We are a little bit below benchmark on that. That's not a performance indicator. That's just a sensitivity indicator. And that's based on shorter term investments to provide you liquidity and also heavier weighted on the short end of the curve, like I talked about before. Yield at cost versus yield at market. This basically means when your investments were purchased, they yielded 3.9%. Those exact same investments in the market today would yield more than that, 4.2%. That is typical in an environment where rates have gone up, which is what we're looking at right now. Your portfolio, we stay out of securitized assets. We're heavy in treasuries, heavy in corporates, and that is very much to your advantage. PFM Asset Management has an excellent credit team, and a high allocation to corporates, I think, has contributed significantly to your outperformance relative to benchmark. This slide here on the bottom left is accountability. Our investments, as I said before, per your investment policy statement, must be investment grade, that's single A or higher. And all of your holdings are single A or higher, with a very heavy concentration toward double A plus and above. I spoke to duration a little while ago. We are, for reasons I spoke to earlier, we're not exposed to the 4 to 5 year range right here. Very heavy on the front end and a lot of the 2-year range as well. That can change over time, but that's us responding to your needs for liquidity and also what the yield curve is presenting to us. This is an accountability slide right here. Not only do we have parameters around overall corporate exposure, but we have limitations to what we can invest in on an individual corporation level. And the highest exposure we have is 1.6% at Cisco Systems, but all of them below that 2% mark. So what that speaks to is a healthy diversification among corporate names. This here shows allocation toward treasuries versus corporates and how it's changed over time. It hasn't changed over the last year. We're hovering around that 20% mark allocated toward corporates. We could go up to 25% for your IPS. And I think the reason for keeping it at the 20% mark right now is we are at historically tight spreads. And once those spreads widen, that will represent an opportunity to increase exposure to corporates. So dry powder is the term that they use. They like to keep some in liquid investments so that there's cash on hand for market conditions and be able to take advantage of that.
Is 25% what you see in other cities as well, like on a standard?
Yes, very much so. Yep. And then here we visited already. This is another accountability slide. We want to perform well for you, but we want to perform well relative to that benchmark. So 3% is only a good return if it's, if it's above what the benchmark is giving you. So long-term, intermediate term, and short-term on that benchmark. So again, that's not just us, that's absolutely you and the partnership that we have working together to achieve good results. We are non-discretionary asset manager. That means we don't make any independent trades. We make recommendations. We're going to pie you for approval. With your approval, we'll execute the trade. So very much a team effort on that. And this represents what that return has translated to over time. 38.6 million going out to 10 years, 3.2 million total earnings in the last quarter alone. These last slides here are our disclaimers and disclosures. And that's the end of my prepared presentation. Happy to answer any questions you might have and go back to the slides.
I'm sorry, go ahead.
Please.
Well, nothing you addressed because we didn't ask you to address it, and it might be a little tangential, but one of our biggest expenses is PERS and our pension costs. These market fluctuations that you've seen, how do you anticipate affecting cities who pay a lot in pensions? Because we have to budget for that too.
Are you talking about how the PERS investments perform?
Yeah, that would be part of it. Yeah, I mean, I just don't, yes, why don't we start with that?
I mean, that would be kind of separate from this discussion. So the Oregon Investment Council manages and oversees the PERS investments on behalf of PERS. They've actually had some shifts here lately, so it might be worthwhile taking some time at a separate meeting to talk about how that shifted.
Yeah, I understand that's not within his portfolio, so to speak, for today, but it just made me curious about how are all these other market forces impacting one of our big costs. It's fine.
Don't take this the wrong way. I just really don't know the answer, but how do you get paid by the city of Salem? So is it by earnings? Do we have a fee contract?
Great question. It's fee based on assets under management.
So it's a set fee.
It's a set fee.
It's not based on actual
Performance, or we made 38, you make 3.8 or something like that. Okay. Just pure curiosity.
It's a flat fee. That's industry standard. Amongst investment advisors, that standard, the alternative to using an investment advisor would be using a broker dealer, which is less consultative and more transaction based. So they would charge you a spread on each individual transaction. We feel like this is in your best interest to be flat fee because you don't want your asset manager to be incentivized to increase the number of transactions. Sometimes there's a reason to make a lot of trades. Sometimes there's a reason to just leave things as they are. So being kind of unbiased toward number of transactions, charged just based on flat fee of assets under management, which is typical for all investment advisors.
Thank you.
Yeah, good question.
I thought this was incredibly informative for me. This was a deeper dive into our investments, I feel like, than I've had. So I thought it was good to at least see the strategy, at least for the next 2 to 5 years. So
thank you for that feedback. Appreciate that.
Absolutely. I mean, we see the reports they come every month.
Yeah.
Quarterly. Yeah. Okay, the packet always feels like it's on. So I always know what's in it. But yeah, it's great. Thank you.
Yeah, thank you. It's a pleasure. Sure. Okay, yeah.
Thank you.
I'll stop there. We'll leave you to your meeting then.
Yeah, Josh, as you can tell, my questions are more like, okay, how does this impact everything else? Like, I love Kristen's question about how is this impacting development? Because she's certainly hearing things, and I like to see how all the pieces of the puzzle fit together. 10,000.
Yeah, absolutely. Definitely does, for sure.
I'll dip out then.
Yeah, thank you very much.
Okay, thank you for your time, and I'll look forward to joining you again in the future.
Yeah, thanks for being here.
So moving on, looks like we have a performance audit update.
Yeah, thank you. I'll turn it over to Tammy with Baker Tilly.
Great. Thank you everyone for having me this afternoon. I'm going to go ahead and share my screen. This will be a brief update today. We don't have any reports for you all to review, but we wanted to talk a little bit about where we were at with this program since we're in a new fiscal year now. So we are just going to look at what we're hoping to do this fiscal year. This is a listing of all of the performance audits that we have completed to date, as well as the date that they were actually completed. So you can see that we've been doing about 2 to 3 per year. And then I also listed out the number of recommendations that have been provided, since we know that that's a lot of work that staff have to do to actually implement those recommendations, and we want to help be supportive in that process as well. The fire overtime performance audit is still in progress. We hope to be able to get that to you at a future meeting later in this calendar year. We're just making sure that all of the data is accurate since it's a pretty data heavy performance audit. So these are the remaining prioritized projects that this group had come up with. We have highlighted in green here the 2 audits that have been recommended for this fiscal year, which is code compliance and planning. IT and police still have a lot of different things going on, and so it just didn't seem like a good time to be able to dive into those areas. And so with each of these, we have an anticipated schedule, which does have a correction on it. So we were talking about the planning performance audit just last week. That team also has a lot going on. So we're in the middle of our sign code review with that team. And we also know that there's a lot of additional work going on relative to the data center. So we've actually pushed out that start date to early winter 2027 rather than starting this month, in order to provide that team with enough time to look at those signed code recommendations, see if those can be implemented before we get into this work, as well as to give them the time that they need on the intensive work that they're doing in other areas. And then the code compliance performance audit is anticipated to start in March of next year. So really both of these performance audits would occur on the later half of the fiscal year. But at the same time, recommendation implementation on all of those other performance audits that have already been completed is still ongoing by city staff. And we know that they're keeping you apprised of that. So are there any questions for me on this update today?
Maybe, I don't know if this is for you, Tammy, or just the staff generally, kind of looking into the package that we have for tonight's work session, the planning services fee study, the development services fee review, those are kind of on the chart for things we need to look at. And so I'm just kind of wondering what the interplay is between the auditing function for planning or even code compliance, and then some of the studies that are undergoing to figure out if we've got enough resources to do these, to carry out these tasks.
Yeah, I can take that. So we actually haven't had conversation about defining that scope for the project. We know the kind of a high level what we are trying to look for that particular audit, but we haven't really sat with Baker Tilly to kind of finalize the scope. When we met with them last week to talk about the scope of that audit, that is when we said, okay, now is not a good time.
Yeah.
So I think there is definitely that opportunity, and through the conversations, not today, but the next conversation in September, when we talk about all these different funds and how we are going to move forward, maybe that is an opportunity to see if any of the council members or the council wants to include something into the scope. We can definitely look into it.
Yeah, and then Tammy, I don't know if you've seen the chart that we see, but it essentially, that planning services and development services fee review and study pushes out into fiscal 28, like the 3rd quarter. So beyond the scope of your audit schedule, but maybe some things for the audit, from the audit, then inform that study, just kind of maybe hopefully how the puzzle pieces might work together. So
Yeah, and also we have an opportunity to kind of do it in phases too. Not everything at once. But
Yeah.
we can also kind of divide that work into different phases.
Yeah, we'll have to talk through it. I think the fee study is a much lighter touch on staff than a performance assessment.
Sure.
Just the number of staff you're impacting is quite different.
Yeah.
Does that generally sound okay? Those 2 audits starting later this fiscal year? Great.
Perfect.
Thank you, Tammy.
Thank you.
I do have a question. Where can we review I know I could dig through old packets. Is there a spot where we can find all of the audits one place on the city's website?
There is. We have a web page set up
Right.
specifically for that.
I will look for that.
And I'll send it out after this meeting, just so everyone has it.
Thank you.
Courtney's done a great job getting that set up and how everything.
Wonderful.
So moving on, economic development assessment discussion.
And I'll introduce it and why we're kind of, there's no staff report or anything with it, is we wanted to bring it here to see if it's something we should move forward with. You might remember there was a motion at the budget committee. That did pass, and is to look at the economic development program and do a performance assessment. Just gonna share it, so you don't mind. So a motion to recommend a study of how the city's economic development programs affect the wages of local workers. The study should encompass urban and rural areas, enterprise zones, business recruitment, any other programs that staff and the city council identifies as central to economic development, and included a potential for the funding source here. When I reached out to urban development staff, it was like, okay, well, should we start work on this? Or I think we felt it was something we should bring to the finance committee to see if it's something the finance committee would like to include as part of the performance assessment portfolio, to even scope it. And see if it's something we want to look at funding.
And it seems like this is the right committee to consider that, and we're already looking at other performance assessments in a way, so I think it makes sense for it to come here.
I agree with you. I think the question is this something the city should consider doing? And if so, I think we would take it back. I don't know, Kristen, how long?
So can I, go ahead. Now, what I was going to say, one is like, if we're going to move forward with this, right? And the second, I think that the bigger question is, it will be, for us, it will be beneficial to at least to talk about what that scope of work is. Because otherwise it could be, we want to make sure that that is something that we can take on, and also for this committee to have a conversation about it. And if required, maybe take it to the council for further conversation. So that's, I think defining the scope for this particular work is important.
I think that's really important to make sure that we're even capable of getting the type of information and results that would be desired here, particularly when we're talking about wage information.
Mhm.
That's really hard to come by, and it's really hard to ascribe that to an urban renewal area, right? So if it's an enterprise zone, we get wage information from those that receive the abatement. We don't get any wage information for those that haven't applied. Same thing with businesses in an urban renewal area. We've got lots and lots of businesses in urban renewal areas that are not grant recipients, and where we have no wage data at all. So this would be a pretty heavy lift with a company like Echo Northwest or something like that, that would have access to larger data sets. But even then, to get granular to what wages are in a URA or an enterprise zone or resulting from economic development activities, is going to be very difficult. So if there are other data sets or other information that would be beneficial, or if this is really important, and we'd like to dive into that and see if it's possible to get that, that's the kind of information I would hope to get.
So I'm just sort of thinking out loud. I mean, I have to file at my nonprofit, I have to file a payroll report with SAFE every year. And I know not everyone uses SAFE, right? But I mean, I don't know at what, I don't know what, they're right across the street. It just seems kind of funny. I don't know to what extent you could collaborate with them to get high level information. The other thought I had is, you're right, there's plenty of people, businesses in a URA, doesn't mean they're actually applying for URA money, using URA money, et cetera. I do wonder whether moving forward, is there a way to, if you're gonna request URA money, you need to, report back, just like a lot of grants, they have conditions, they have prog report requirements. You have to show, did you spend the money like you told us you would, and so on. Is it something we can do? This is a separate question from this. Could we, moving forward, say, if you want URA money, you have to report the wages back to us as a condition?
So yes, for those that are direct businesses that are getting grants, the challenge is a lot of our grants go to landlords, not to the businesses, and they go to tenant improvements.
Yeah.
Right? Or they go to a developer for housing, or they go to the city for public infrastructure. And so there's not a direct correlation with we're giving a grant specifically to a business. I mean,
That's
that
right.
happens, but it's a very small amount of the actual grants.
Mhm.
And then, like your wage information going to SAFE or Department of, that's proprietary information and not something we would be able to access.
I guess I'm trying to figure out exactly how. Like most of the studies that we do, like the other ones, they're targeting a problem, right? And something that we've identified. So for instance, when we look at fire, it's overtime, right? We're targeting performance evaluation, basically to determine how can we solve this problem. This one's a little harder for me because I don't know exactly what target, what question we're asking and what target we're trying to hit and what problem we're trying to solve, and how I would personally be able to use the data, specifically the this economic development program area, to be able to say, okay, if we aren't meeting this, our benchmark that we haven't really set of what it should do or shouldn't do, I guess I'm not quite clear on if it's going to be a heavy lift and it's going to be expensive and it's going to be staff time. I want to make sure it's valuable in the end, and I'm not quite sure how this data I could use value or make it valuable, but that's just my vision. I'm kind of hoping that someone can explain to me better how we can use it. So.
Well, I think it would be helpful if we had, I don't remember if there was a background. Oftentimes a motion comes with a background section that explains the basis for the motion, but as I said here today, I can't recall it, and I would want to misinterpret.
I mean, I guess I see this as like, there's two buckets in this statement. One bucket is the wages of local workers, and then the other bucket is our economic development program. And the motion believes that we could know one thing about the other from each, like how much economic development leads to, and I think even in our conversation as a committee at the time, we said that that'd be very difficult to identify. I do think that there would be lots of benefits for us understanding those buckets better. Like, what's the current wages in Salem? What are they, relative to other communities in Oregon? I mean, you could build some correlation data without necessarily like saying causation. You could also characterize the second bucket. This is what we do for economic development. People are very interested right now in our SEDCOR contract. What does SEDCOR do with that money? What do we ask them to do with it, et cetera, et cetera. So like we could have at least an information report that characterizes these buckets a little bit. I think that would be helpful. I think people have, in general, have a lack of understanding of how depressed wages are in the city of Salem, and characterizing those across the rest of the state would be helpful for us to know as a council and to share with the community. And I also think that we don't have a great sense of what other economic development tools are out there that we're not using.
I think it's well said.
I have a hard time saying, if there's specific things like, oh, we do these particular enterprise zone grants and they tell us about the wages. Okay, well, let's detail that as much as we can because that's the data we have. But I think we're gonna go broke trying to demonstrate that, the urban renewal dollars are turning into wages. Like, I don't think that's.
I think you can kind of look at it more macro basis, because urban renewal and the enterprise zones, I mean, we're looking at traded sector jobs, we're looking at bigger companies that bring in industry. And, we can get you some macro numbers about, what is this type of industry? What is the average wage in Oregon for this type of industry? So, we've got the deep freeze
place over off of McGilchrist, and we've got, different businesses in Mill Creek. We can get you macro data on that. And we can give you what the property valuations are for that data for those properties compared to when the URA started, compared to where we are now. And I don't know the total number of jobs created and things like that. That's probably a bit of work to get into, but that can give you just on a broad brush scale about, what is your urban renewal dollars doing? You can look at Fairview, you can look at North Gateway, you can look at, right here next to the SAFE for that matter. It's here because of urban renewal.
Yeah.
There's a lot of ways you can get you some broad indication of what it's doing for you without specific wage data.
Yeah, it's much more straightforward. Get that information.
I think the community is also asking us to consider land use categories right now, like what's appropriate for an employment center. And maybe there's certain things that could be, I don't know, if you're saying like, well, for this type of development, this is the average wage. So if a semiconductor chip manufacturing facility has this kind of wage, and a data center has this kind of wage, and a warehousing distribution center has this kind of wage. I don't know, I don't want to go too far down this road in this conversation, but there's, maybe there's some helpful information there in terms of like, oh, why we zoned these things is because we're trying to create these kinds of jobs, or if we created this kind of job, this is what we'd expect it to look like. I'm just trying to see, like, could we do something that would actually inform other decision making too, and inform the public along the way?
I'll just say I too hear in community a lot about when the royal we, when it's said for whomever recruits certain businesses to the area, what kind of wages are they bringing to the area? If you say, I want 50 acres, and it's one job per acre, I'm like, and once it's, given to you for however long, there's an opportunity cost, right? It's like, should we have said yes to the first person who said, I want to develop this 50 acres, knowing that there might have been, if you waited a little longer, maybe there was someone who came in with higher job opportunities. I don't know. But yeah, I mean, we still have some places where people can come. We still have some vacancies here, right? But once that land is taken, it's taken, and there's an opportunity cost involved with whomever you recruit to those areas. I think, like Paul said, most people don't know what we do in economic development business, and so making sure our budget committee and our entire council is educated on what we do, what we don't do, is always a good starting point, and could help us further define the scope of work. Once we fully have a shared understanding of like, well, it's just like Kristen reminded me, URA money often goes to the property owner, not the actual business. And I love the fact that we started to create more flexibility in that regard. I would love to see more of that. But I think we have to have a shared understanding before we dive into a study and understand scope of work, I think.
I think all of that exactly speaks to kind of some of my hesitation, because even as we talk about salaries, it's salaries that we're after, is there quantity of jobs that we're after? And so both numbers are different, right?
Yeah.
And then taking that, is an industry that's growing or depressing? Obviously, AI seems to be growing from the report we just saw. Manufacturing may not have that same outcome, yet it may have a higher quantity of jobs. And so I guess that's where I'm hesitant on like proving or saying, yes, this is a valuable data to get, because I guess I don't really have clear understanding in how we keep the data as a city yet. So I think Paul's, to your point, like how can we create a report or do a study that informs the community and still is valuable for the city in some way and not just busy work, because that's just not what we want. And so I guess that's kind of the question. Is there a report or a study that's beneficial to your department?
I think some of this broader information that you're discussing, I think that would not be a super heavy lift to get that information. I think it's much more readily available and something we could bring back as an information report to share. I think as part of that too, it's an opportunity to, share with the community that when we're talking about a parcel and how many jobs per acres might go there unless we get really granular with our zoning. These properties are owned by other entities. We don't have control of them. And if they negotiate a deal with a company that's warehouse distribution as opposed to semiconductors, unless we zone at the level that says this parcel can be, only this, and we can start eliminating a lot more,
Right.
we don't have much say
Yeah.
in what we're gonna get.
So Kristen, if I may, so based on what I'm hearing from the committee. So just like any other audit, what we have, the way we have been operating, whether it is fire or any other, sign code. We want to kind of evaluate what our current practices and programs are, right?
Yeah.
And then from that, we are looking for, okay, what are the opportunities for us to improve? And I know audit is kind of sounds like we're doing something wrong, but that's not how we have been approaching it. It's just like, okay, we know that we're operating this way today. And let's figure out if there is a better way to do it, and then see some opportunities to improve, right? I kind of see this the same way based on what you guys have been talking about. I think we have current practices and programs that have been there for a while. It's an opportunity for the community to understand how we are operating today. And then through the audit, we can definitely kind of focus on what improvements do we have, can be made if the end goal is XYZ, whatever that is, right? So that's one way to your point, Councilor Matthews, like if we want to have like some statement about the problem that we are trying to solve, that is one way to approach it, just like how we have approached other audits.
I think the other thing that's kind of popping into my mind as we talk about this, and I don't think this passed, but I didn't vote for it, but that's okay. I just want to get as much of the thing that I think people were saying was, we're spending X dollars on economic development. Are we getting Y benefit? Right? Are workers getting the benefit? And taking that as earnestly as we can. I think we know that we here in this room might know that we spend probably a lot less on economic development than people think. And spending on urban renewal doesn't always count, as people might think it does. And so I guess my point is, what other kind of, can we bring the information back to the budget committee in a way that's helpful to them, and doesn't, isn't just is generative to them, they can have ideas and more feedback based on it. I think the other decision that we're facing is whether and when to open other urban renewal areas, right? And if there's any sort of description of the impact of like Dan was saying, the positive impacts of the urban renewal areas that we've had so far in the last, 25 years, then that can give us more decision information for potential new urban renewal areas beyond North Waterfront. So that's the other thing that I would give some advice on.
And so can I ask, I know we're kind of past 5, but so also what I'm hearing is you're also asking for some kind of a framework that allows us to make future decisions as we are kind of looking into new URAs, and is that what you're saying?
Yeah, framework or just.
Not picking a spot on the map, you mean?
I mean, it's just at some point, we're gonna
Not that
have
we're not
other
intentional.
spots picked for, I don't know what they are, but it's if we picked this for this reason, connected to the potential to grow wages like this. If these kinds of employers came to town, we'd expect the wage benefit to be,
Okay.
again, it's really correlative. It's not causation, it's really correlative, but it at least gives us more to think about in terms of I wish there were some buildings out by the airport. Well, why? What would that development near the airport get the city? Because aviation jobs are 30% better than, general manufacturing jobs or whatever, that kind of thing.
So would sorry, go ahead.
I'm just saying that I made that up. That's not true.
So I know because we're at 5, but would a good path forward probably is for us to kind of at least work on that initial scope based on the conversation tonight, and then we can bring that back to this committee for further discussion.
And kind of the overarching, economic conditions, I think that are pretty easy to get to. And then we can narrow in what you're actually looking
I
at.
think that's.
Yeah, I mean, and I would just put a thing on the horizon for the budget committee, like when could something come to them that they don't also have 17 other things to talk about? Usually that's like the December or the January meeting, but is it? I don't know.
Yeah, I mean, we're looking at scheduling a meeting in October, and we have in January, and then it's really busy.
Yeah,
So if there was something like this, we might have to see what that looks like. I think you're picturing just as information back to the budget committee. Is that what you're picturing?
yeah, I mean,
They did bring the motion.
yes.
Seems appropriate, and ideally you would do it in one of the earlier meetings before we get into the meat of things. Agree. I want to make sure we talk about SEDCOR as part of that. It's my understanding that Kaiser and Marion County are no longer a part of SEDCOR, and I'm just kind of curious. I just heard. So I'm just wondering what that looks like and what our relationship is like.
Sure. It is, I mean, only because I agree with the idea of bringing it back to a budget committee, but also recognize that it's already August, and so.
Yeah, I know.
And the whole intention here was that you were gonna bring back a scoping to us next time for us to approve before you can start. So what is the reality that in 4 months, assuming that we did it in the December meeting? Is that really practical? This should not be, I wouldn't think top priority. That would be my opinion, this shouldn't be a top priority.
December maybe or January, is there December? Yeah.
I think maybe that's part of what we can bring back next time. We can talk about what that looks like, because I think it's really important information. Is it gonna inform the budget proposal for next year? I don't know.
Right.
So it might be better to bring it back in the fall of next year after it's fully executed and understood.
You got it.
Is there anything else? Then we are adjourned.